Okay, let's just get right into it. Almost everything you see online about investing, it was completely made for Americans. You constantly hear about 401ks, Roth IRAs, or, buying US funds like VOO. But look, if you live in Europe, almost none of that applies to you. Actually, as we'll see in this explainer based on the excellent guide by Old World Money, blindly following that US-centric advice can lead you straight into some serious regulatory roadblocks and completely unnecessary tax nightmares. So today, we're just going to strip away all the complex jargon. This is going to be a calm, structured, completely beginner-friendly walkthrough of how investing actually works for everyday Europeans. By the time we wrap up, you're going to know exactly what you need to do to get started this very week.
All right, let's dive into this. We're going to break this down into a really simple 5-part roadmap. First, we'll tackle the silent problem. Then, what investing means, the European ETF solution, 3 practical steps to start, and finally, the golden rules.
So, kicking things off with part 1, this silent problem, and why our savings are actually shrinking.
For a lot of us, leaving money untouched in a standard bank account feels incredibly safe, right? Like you're doing the responsible thing. But that safety is kind of an illusion. It hides a very real risk. There's this number you absolutely must keep in mind, 2 to 3%. That right there is the European Central Bank's long-term target for inflation. And what that means is, if inflation runs at just 2 to 3% a year, money that is just sitting perfectly still loses roughly a quarter of its real purchasing power every single decade. It's like having a euro coin that physically shrinks in your pocket. The number on your bank statement? Sure, that stays exactly the same. But what those euros can actually buy quietly evaporates year after year. And this brilliantly illustrates the real issue with that age-old advice to just save more. Relying on saving alone is essentially a flat trajectory. I mean, you can aggressively cut expenses, sure, but you always hit a ceiling. Investing, however, completely bends that trajectory upward. It essentially puts your money to work right alongside you with the goal of outpacing that inflation through the power of compound growth. When you zoom out over 20 or 30 years, the massive gap between that flat, stagnant saving strategy and an upward compounding curve, well, that can literally be the difference between retiring comfortably and seriously struggling. Okay, let's move on to part 2, what investing actually means. We really need to demystify this.
The word investing carries so much unnecessary baggage. People think it's just for the wealthy or that it's basically just gambling. But at its core, investing simply means you own a small piece of a real business. Think of it like holding a tiny puzzle piece that's connected to an actual physical storefront. You are absolutely not just placing bets on random blinking numbers on a screen. You are becoming a fractional part owner of a company that actually sells real products, employs real people, and makes real money out in the world. And the best part? You absolutely do not need a fortune to start claiming these pieces. You can easily start doing this with less than 50 euros a month.
Now, obviously, buying just one single company's puzzle piece is pretty risky, because if that specific storefront struggles or goes under, well, your money struggles right along with it. And that is exactly where an ETF comes into play. ETF stands for Exchange Traded Fund. You can just think of an ETF like a tightly woven basket. So instead of buying into just one single company, one single purchase gets you a basket that contains tiny, tiny slices of hundreds or even thousands of different companies all at once. If one company in there has a terrible year, your money is insulated. It's protected because you still own pieces of everything else in that basket. That right there is the magic of diversification.
Which brings us to part 3. And pay close attention here because this is the European trap, UCITS versus US funds.
Now, what's really interesting about this comparison is that this is the exact spot where standard internet advice completely leads Europeans astray. Because of a set of regulations known as PRIPES, U.S. domiciled funds are largely restricted. They literally just cannot be sold to everyday retail investors across the EU. And honestly, even if you manage to find some sort of loophole, the resulting tax complications would just be an absolute nightmare. So what's the solution? The gold standard for us is the UCITS ETF. These are specific baskets built and, crucially, regulated exactly for European investors, complete with super clear tax treatments. And here's a vital pro tip for beginners. Always look for what's called an accumulating UCITS ETF. Why? Because these magically take your dividends, your cut of the profits, and automatically reinvest them right back into the fund. It drives that compounding growth curve we talked about earlier upward, and it does it without you lifting a single finger or accidentally triggering unnecessary tax headaches.
All right, let's get into part 4. 3 highly practical steps you can take to start.
We're moving from the theory into a calm, straightforward action plan.
Step 1 is choosing your broker. That's just the platform where you're going to buy your basket. You want to look for one that is strictly regulated in Europe, offers those UCITS ETFs we just discussed, and operates under standard European investor protection schemes. Step 2 is simply picking what to buy. And then step 3, you automate it. You set it up as a recurring loop on your calendar every single month. Honestly, opening an account on a regulated European broker usually takes less than 20 minutes. It's that simple. Now, regarding step 2, picking what you're actually going to buy, what you generally want is a broad world index. Try to picture a giant basket woven from dozens of different global economies. The strategy here is, well, it's deliberately boring. You are absolutely not trying to be a genius, pick the next hot stock, or perfectly time the market. No, you're just buying one single massive basket that holds a tiny piece of the entire global economy. You're making a completely reasonable, long-term bet that overall human progress is going to continue. Always remember, the goal here isn't excitement. The goal is consistency.
And that leads us perfectly into part 5, the 3 golden rules of investing behavior.
So, the crucial point here is that setting up your account is actually the easy part. How you behave once the money is in there matters so much more than what you buy. First rule, you have to think in decades, not months. The market is going to go up and it's going to go down. That is perfectly 100% normal. Second, never ever panic sell during a drop. If we look at history, global market crashes have always, eventually, been followed by a recovery. If you sell out of fear during a temporary dip, all you've done is turn a temporary situation into a permanent, locked-in loss. And third, please ignore hot tips. Chasing after some trend that sounds too good to be true is basically the fastest known way to completely destroy your hard-earned wealth. Because the reality is, true wealth in Europe has never been built by chasing flashy trends. It has always been built slowly and quietly by people who simply understood patience better than they understood the stock market. So, I guess the final question you have to ask yourself is, are you ready to stop letting your savings quietly shrink away and instead finally let time do the heavy lifting for you? If you found this breakdown valuable, I'd highly invite you to dive deeper into the incredible practical financial history and education offered by Old World Money. Thanks so much for joining me on this explainer, and I'll catch you on the next one.